At Alitis, we use all the asset classes that we can get access to on any kind of reasonable basis. Obviously, we use stocks, we use bonds, and cash and any other instrument like that a traditional broker would invest in there, and that's fair. Those are fundamental to any portfolio. But we're also of the opinion that it's, and that's the reason Alitis was started, is it's not going to carry you to the future. Interest rates are pretty low these days, and after costs and fees, there's nothing left over, or very little left over. So you need to find something that's alternative to that provides a better cash flow, better income, and that's where our mortgage pool comes in on the fixed income side. That one is yielding north of 7%, and a very short term to maturity as well too on average.
The risk for the mortgage investment fund, I would say, is low in comparison to other mortgage investments. Due to our diversified strategy, we're not investing in just one mortgage or a handful of mortgages. We have the 3 different investment strategies: investing directly into mortgage investment funds, our publicly listed portfolio, as well as our privates. At the end of the day, we have exposure to over 9,000 different mortgages within our fund.
So what you get is a higher yield with a short term to maturity. So if inflation does start to kick back in, which there is talk of these days, that one we protected. It's going to earn its way out of any problems. Whereas if you take a traditional bond yielding 2% if you're lucky, then we're going to have a little problem. If inflation kicks in, you're going to have erosion of your capital, your purchasing power of your capital, and that is not good for your portfolio over the long term. Right now, there's a transition in this world, and risks that we don't even know exist, or we don't know how to even quantify them, are appearing. And this is the time when a diversified portfolio matters the most. And for us, that's why at Alitis, we have the traditional investments, but we also have those alternatives, which provide a different exposure to different risks, which will hopefully mitigate and allow you to roll through. If any other unknown risks come up, we allow us to pass through those with a much better manner than if you didn't have them in your portfolio.